Welcome to this episode of PhillipCapital's Market Watch. I'm Miaomiao, a Senior Research Analyst at Phillip Securities Research. Today, I'll be presenting the market outlook on the Singapore S-REIT sector, focusing on its recent performance and our subsector preferences. The S-REIT index fell 2.9% in February 2025, reversing its 0.2% gain in January. The top performer for February was Paragon REIT, surging 9% following a privatization offer of 0.98 per share in cash. The worst performer was Manulife US REIT, falling 23.2% as their financial metrics remain stretched. Looking at the broader interest rate environment, the US Federal Reserve held its benchmark rate unchanged at 4.25% to 4.5% in March. However, the market expectations have shifted, with investors now pricing in 4 more rate cuts in 2025, up from 1 just a month ago. In February this year, the Reserve Bank of Australia cut its cash rate by 25 basis points to 4.1%, making the first reduction since November 2020. The move is expected to benefit S-REITs with Australia exposure. Similarly, the Bank of England lowered rate by 25 basis points to 4.5% in February 25, further reinforcing the global shift towards monetary easing. With the expectation of additional rate cut on the horizon, S-REITs, which have underperformed the STI year-to-date, may see renewed investor interest. S-REITs are now trading at a forward dividend yield spread of approximately 4%, aligning with their 10-year average. At this level, we consider it as an attractive entry point. Looking ahead, we expect dividend per unit to grow approximately 1% in 2025, with roughly half of S-REITs expecting to benefit from interest saving this year, while remainder is likely to see improvements in 2026. S-REITs are currently trading at a price-to-net asset value of 0.8 times, which is 1.6 standard deviation below its long-term mean of 1 times. This suggests a notable undervaluation. In the first half of 2024, the NAV increased by over 10%, which reflected improving market sentiment. As the market anticipates interest rate cut, it is likely to repress S-REITs in anticipation of higher property valuations and stronger rate performance. As fundamentals improve, we expect the discount to NAV to narrow further, making its sector increasingly appealing. Among the various subsectors, we have overweight stance on the retail and hospitality subsectors. Retail sales rebounded strongly in January 2025, rising 4.8% year-on-year after a 4% decline in December 2024. This recovery was partially due to the earlier timing of Chinese New Year celebrations, which boosted consumer spending. If this momentum continues, retailers may be more willing to pay higher rents. Tenant sales remain resilient at approximately 20% above pre-COVID levels. Yet, occupancy costs are still below pre-pandemic averages. However, demand for higher ticket items, including luxury goods and fine dining, remains subdued. The recovery of international visitor arrivals to near pre-COVID level is expected to spur spending, although some consumers remain cautious, opting for more affordable alternatives. Moving forward, we expect tenant sales to improve marginally in 2025, supported by rising international visitor arrivals, population growth, and government payouts. Consequently, we expect to see high single-digit positive rent reversion for retail in FY25, particularly as Singapore solidifies its status as global tourist and business hub. The hospitality sector continues to experience robust recovery, supported by increasing international arrivals and sustained demand for accommodations. In January 2025, revenue per available room in Singapore grew 6.5% year-on-year, supported by a 4.3% increase in occupancy to 82.5%. Meanwhile, international visitor arrivals increased 15% year-on-year to 1.6 million, reaching 97% of pre-COVID levels. A key highlight was the strong rebound in Chinese tourist arrivals, which jumped at 78% year-on-year for January 25, surpassing pre-COVID levels by 14%. These trends suggest that international visitor arrivals could reach 95% to 100% of pre-COVID levels in FY25. Looking ahead, we project a low single-digit RevPAR increase for FY25, even with a projected 1.7% compounded annual growth rate in hotel room supply over the next 3 years. Notably, the Singapore exclusive Lady Gaga concert in May 2025 might support second quarter 25 RevPAR growth, although its impact is expected to be more moderate compared to Taylor Swift's concert in March 2024. In conclusion, we remain overweight on S-REITs, with a preference for those with healthy balance sheet, strong sponsors, and improving operating metrics. We believe S-REITs that can deliver sustainable DPU growth in a higher interest rate environment will be best positioned to outperform. I hope the insights shared today will benefit your REITs investment journey. If you have any questions, feel free to reach out to us at Phillip Securities Research. This concludes this episode of PhillipCapital's Market Watch. Don't forget to like, follow, and subscribe for more updates. Thanks for joining us.